There is a family in Switzerland. No, you won't find their name on Forbes. You won't see them on the cover of any magazine. Their children don't post on social media. Their estate doesn't appear in any public record. And yet, they have been quietly compounding wealth for 4 generations. Not millions, not tens of millions. We're talking north of $200 million, built and maintained almost entirely in silence. Now here's what's strange. The patriarch of that family didn't invent anything. He didn't build a tech startup. He didn't strike oil. He made smart decisions, specific, deliberate, repeatable decisions that most people will never even hear about, because the people who know them have no incentive to teach them. That's what this video is actually about. Not motivation, not mindset fluff, not another top 10 list of habits of successful people. This is about the specific mechanics, the psychological architecture, and the structural strategies that families worth $50 million and above use to build, protect, and multiply wealth across generations, while everyone else is stuck playing a completely different game. And I'll warn you right now, some of what you're about to hear is going to feel uncomfortable, because it forces you to confront the possibility that everything you've been taught about money, saving, investing, working hard, diversifying your 401k, was never designed to make you truly wealthy. It was designed to keep you financially stable enough to keep working. There's a difference, a massive one. And by the end of this video, you will understand exactly what that difference is. But first, we need to talk about something most financial content refuses to acknowledge. There are 2 completely separate financial worlds operating simultaneously on this planet. Same economy, same markets, same inflation, and yet radically different outcomes. Why? That question is going to follow us through this entire video. And the answer, when it finally comes, is not going to be what you expect. Let's build the full picture. For most people, wealth is thought of as a number, a savings account balance, a net worth figure, maybe a retirement portfolio. The goal, as most people understand it, is simple. Earn money, save money, invest money, retire with enough money. That's the script. It's been handed to every generation since the mid-20th century, and it works, to a degree. It keeps most people financially surviving. It even allows some people to build modest comfort. But here's where the divergence begins. Families in the ultra-high net worth category, the ones managing 50 million, 100 million, 200 million and beyond, do not think about wealth as a number. They think about wealth as a system. And that distinction is not cosmetic. It is foundational. It changes every single decision they make, from how they structure their business income, to how they think about their children's education, to which professionals they hire, to how they respond to a market crash. In the 1970s, a sociologist named Paul Shervish spent decades studying wealth at the highest levels. What he found was not what most people expected. He discovered that the ultra-wealthy were not simply better investors. They weren't luckier, necessarily. They weren't all geniuses. What separated them, consistently, was something he called a culture of philanthropy and governance. In other words, they had built internal rules, internal structures, a philosophy of wealth that operated independently of any single market condition or economic cycle. The wealth wasn't in the assets. The wealth was in the architecture, and that architecture, the private playbook that governs how these families actually operate, has been almost entirely invisible to mainstream financial culture, until now. Let's talk about the first principle that changes everything. The average person thinks in terms of one financial life. Their own. Maybe they extend that thinking to include their spouse, their children. But the time horizon is essentially 1 generation, maybe 2, if they're particularly forward-thinking. Most financial planning in the mainstream world is built around a single human lifespan, roughly 70 to 90 years. Families worth 50 million and above think in a completely different time dimension. They think in dynasties, not metaphorically, literally. They have family documents actual written constitutions that outline values, decision-making protocols, investment philosophies, and governance structures intended to guide behavior 100 years into the future. Some of the oldest family offices in Europe operate from charters written in the 1800s that are still in use today, not as artifacts, as active governing documents. This is not a romantic concept. It is an operational advantage of almost incomprehensible magnitude. Here's why. When your time horizon is one life, your financial behavior is shaped by short-term pressure. You need to retire by 65. You need to pay your mortgage by the 15th. You need your portfolio to recover before you're too old to work. Every financial decision is compressed into a narrow, urgent window, and that urgency, that constant pressure, is what drives people to make reactive decisions. Panic selling during downturns. Over-concentrating in what's trending. Cashing out early to meet immediate needs. But when your time horizon is 100 years, when you are managing wealth for grandchildren not yet born, the entire psychological landscape changes. Volatility becomes irrelevant. Market cycles become opportunities. Liquidity constraints that would destroy a normal investor simply don't apply in the same way, because the family can afford to wait. They can hold illiquid assets for decades. They can absorb short-term losses as the cost of long-term positioning. Time, at this level, is not a constraint, it is a weapon. And here's the deeper truth. The families that understand this don't just have more time. They engineer more time. Through trusts, through corporate structures, through family-limited partnerships, they build legal and financial vehicles that effectively extend their investment horizon beyond any single human life. The money never has to end. It just transforms. It compounds. It passes through legal structures specifically designed to minimize friction, minimize taxation, and maximize continuity. Now we're getting into territory most people have never seen. Let's talk about tax, because this is where the gap between the wealthy and the ultra-wealthy becomes almost surreal. Most people think of tax strategy as finding deductions, maximizing your 401k contribution, writing off your home office, maybe hiring an accountant who can find a few extra credits here and there. This is not tax strategy. This is tax compliance with a slightly more aggressive posture. And the people managing $50 million portfolios are not playing this game. They are playing a different game entirely. At the ultra-high net worth level, taxes are not an annual event. They are a continuous, structural engineering problem. And the people solving that problem are not accountants. They are tax attorneys, estate planning specialists, trust architects, and in many cases, teams of professionals who work together in what's called a family office. A private, dedicated financial infrastructure, sometimes employing 10 to 25 professionals, built to serve a single family's financial interests. The numbers here are staggering. McKinsey research and various family office surveys have consistently found that families with dedicated family office structures save between 2 and 4 percentage points in annual return leakage from taxes and fees compared to individuals managing similar assets through conventional channels. Over 20 years, on a $50 million portfolio, that difference compounds to something in the range of $25 to $40 million in additional preserved wealth. Not earned, preserved. Money that simply didn't leave. One of the primary tools in this preservation effort is the irrevocable trust. Not a basic revocable living trust. Everyone has heard of those. We're talking about sophisticated vehicles like spousal lifetime access trusts, grantor-retained annuity trusts, and dynasty trusts structured to last multiple generations without triggering estate or gift tax at each transfer. The legal mechanics here are complex, but the principle is elegant. The wealthy have figured out how to move enormous sums of money through time, from generation to generation, while paying a fraction of what the tax code would otherwise demand. And this isn't tax evasion. It's completely legal. It's been legal for decades. The tax code, in many ways, was written with these strategies in mind, because the people who wrote the tax code were themselves wealthy, and they built in structures they planned to use. That's not cynicism, that's history. But this is where everything changes, because up until now, we've been talking about mechanics, structures, legal vehicles, and while those tools are powerful, they are not, by themselves, what separates families that sustain wealth for generations from those that lose it. The research on this is brutal. About 70% of wealthy families lose their wealth by the second generation. 90% have lost it by the third. 70. 90. Those are not small numbers. Those are near certain outcomes for families who do not have what we're about to discuss. If you've been paying attention to this channel and you find this kind of deep dive useful, take a second and subscribe. More frameworks like this one are coming now. Back to the 90% figure, because it deserves a lot more attention than it gets. To the stable. Every culture independently has noticed the same pattern. Wealth rarely survives 3 generations. And the question that the ultra-wealthy have spent an enormous amount of energy answering is, why? And more importantly, how do we stop it? The answer, when researchers like Jay Hughes and James Grubman dug into it, was not financial. It was psychological. It was relational. It was, at its core, about human nature. The first generation that builds wealth is almost always driven by scarcity. They remember what it felt like to have nothing, or to have very little. That memory is a motivator. It's uncomfortable, and it's powerful. The second generation grows up watching that drive, inheriting some of it, but also inheriting the comfort that the first generation's success created. They understand money conceptually, but have rarely felt the visceral urgency that forged it. The third generation grows up in full abundance, with no living memory of the scarcity that built it. And if the family has not actively, intentionally transferred not just the wealth but the values and the psychology behind the wealth, the third generation is essentially starting over, in designer clothes. The families that break this pattern, the ones who make it to the 4th, 5th, 6th generation, have figured out something profound. You cannot simply transfer assets. You have to transfer the decision-making culture, the philosophy, the emotional relationship with money. And you have to do it deliberately, systematically, across every generation, as if the culture itself were an asset that requires maintenance and investment. This is why the wealthiest families have formal governance structures, family councils, annual meetings, not just to review investment performance, but to reinforce shared values, to discuss what the family stands for, to involve younger generations in real financial decisions before they inherit responsibility they're not prepared for. Some families have mentorship programs where teenagers sit in on board meetings. Some have formal financial education requirements for heirs. Some even require young family members to start a business or demonstrate financial competency before accessing family assets. This is not accident. This is intentional architecture, human capital management applied to a bloodline. And here's the darker truth that most people never see. The families who lose their wealth across generations almost always lose it for the same reasons: legal disputes between heirs, lifestyle inflation that quietly outpaces returns, a single bad decision made by an unprepared heir, or the slow erosion of financial discipline once the founding generation is gone. The families that keep it, they've studied these failure modes. They've built governance structures specifically to neutralize them. They've had uncomfortable conversations that most families avoid, and they've documented their financial philosophy in a form that survives beyond any single person's lifetime. Now let's talk about investing, because this is where the playbook gets genuinely counterintuitive. Most retail investors operate in a world defined by public markets: stocks, bonds, ETFs, mutual funds. The logic is straightforward. Public markets are liquid, regulated, and accessible. You can put money in on Monday and pull it out on Friday. This accessibility is sold as a feature, And for most people, it is. But for the ultra-wealthy, that same liquidity is often viewed as a constraint, or worse, a trap. Here's what I mean. Public markets are, by definition, the most contested financial battlefield on Earth. You are competing every single day against professional traders, algorithmic systems, hedge funds with billions in computing resources, and analysts whose entire careers are dedicated to finding the same inefficiencies you're looking for. The idea that an individual investor or even a moderately sophisticated family can consistently outperform in that environment is statistically questionable at best. But private markets, private equity, private credit, direct real estate, infrastructure, investments, private venture placements, the competition is dramatically thinner. The information asymmetry can favor the patient, connected investor. And the return premium, the extra yield that illiquid assets offer compared to public equivalents, is well documented. Studies from Cambridge Associates, Prekin, and major institutional investment research consistently show that top quartile private equity returns outpace public market equivalents by 3 to 5 percentage points annually over long periods. 3 to 5% doesn't sound dramatic, but compound it. On a $50 million portfolio, maintained over 20 years, that differential creates an outcome gap worth tens of millions of dollars. The reason most people can't access this isn't sophistication. It's liquidity requirements and minimum investment thresholds. Private equity funds often require minimum commitments of $2 to $5 million, with capital locked up for 7 to 10 years. For most investors, that lockup period is terrifying. You need that money accessible. But a family operating with a 100-year time horizon? A 7-year lockup is essentially rounding error. Once again, time is the weapon. But the ultra-wealthy don't just invest differently in terms of asset class. They invest differently in terms of information. This is the part of the playbook that is almost never discussed publicly. There is a network effect to wealth that most people underestimate to a shocking degree. When you are managing serious capital, by the above of 50, 100, 200 million, you become a different kind of counterparty. You get invited to different rooms. You get access to deal flow that never reaches a public platform. Private placements, co-investment opportunities alongside major funds, early access to real estate developments before they're listed, direct stakes in private companies that will never appear on an exchange. This isn't illegal information. It isn't insider trading. It's simply that at a certain level of capital, the market that's available to you changes entirely. You're no longer shopping in the same financial store as everyone else. You've been quietly escorted to a back room where the real merchandise is kept, and the families who sustain wealth for generations, they teach their children how to find that room, who to know, what signals to send, how to present themselves as serious capital partners, how to evaluate and negotiate direct deals, not just how to pick a mutual fund. Let's go deeper. Because we haven't talked yet about perhaps the most psychologically sophisticated element of the ultra-wealthy playbook, and it involves something that on the surface looks almost like generosity. It's called strategic philanthropy. Now, most people think of philanthropy as what you do after you've made your money. You've succeeded, you've accumulated, and then, perhaps out of guilt, perhaps out of genuine altruism, perhaps for the tax deduction, you give some away. That's not what we're talking about. At the ultra-high net worth level, philanthropy is frequently a component of the wealth-building architecture itself. Not in a cynical sense, though critics do exist, but in a structurally sophisticated sense. Donor-advised funds, private family foundations, charitable remainder trusts. These vehicles allow the ultra-wealthy to accomplish several objectives simultaneously. They reduce taxable estate value. They generate current year tax deductions. They create controlled vehicles for deploying capital into causes that the family values, including causes that may align with industries or policy environments where the family also has investment interests. A private family foundation, for instance, is required to distribute only 5% of its assets annually to charitable causes. The remaining 95% is invested, and can be invested in ways that align with the family's broader financial strategy, including impact investments that generate both social returns and financial returns. Meanwhile, the family controls the board of the foundation. The family name is associated with the foundation's charitable mission, and the foundation effectively becomes a multi-generational asset vehicle that is exempt from many of the tax obligations that would apply to a standard investment portfolio. Is this generous? Often, yes. Is it also financially strategic? Always. The ultra-wealthy do not separate their philanthropic activity from their financial architecture. They integrate it, and in doing so, they create vehicles that accomplish things no standard investment account ever could: multi-generational wealth preservation, tax efficiency, reputational capital, and genuine social impact, all in the same structure. This integration, the ability to make a single decision that simultaneously advances 5 different objectives, is one of the hallmarks of how families at this level think. They are not thinking linearly, they are thinking in systems. Every decision has multiple angles, multiple time horizons, multiple constituencies, and now we arrive at the deepest layer of the playbook, the one that is hardest to teach, the one that no financial advisor will ever bill you for because it isn't technically financial advice. It's the psychology of what researchers call the stewardship mindset. Every ultra-wealthy family that sustains its wealth for generations, and I mean every family without exception in the research, operates from a shared belief that the wealth does not belong to them. It belongs to a mission, a legacy, a responsibility to past and future generations. The individuals in the family are not owners of the wealth, they are stewards of it. This framing changes behavior at a neurological level. When you believe you own something, truly own it, in the conventional sense, you feel entitled to use it however you wish. You feel the psychological freedom to spend it, risk it, consume it. Your wealth becomes a resource for your personal satisfaction. And that feeling is completely natural. It is what most people experience when they receive an inheritance or a windfall. But when you believe you are a steward, a temporary guardian of something larger than yourself, the psychological relationship with wealth transforms. Reckless spending feels like betrayal. Impulsive risk feels like irresponsibility. The question shifts from "what do I want?" to "what will this produce for those who come after me?" This is not a mindset that develops naturally. It is cultivated intentionally, through family governance, through storytelling about the family's origin, through rituals and meetings and documents that consistently reinforce the narrative that the wealth is a living thing, a trust, that each generation has both the privilege and the obligation to protect and grow. Some of the most fascinating research in this field comes from families who have commissioned their own sociological studies. Yes, some wealthy families actually hire researchers to study their own culture and dynamics. What these studies consistently find is that families who sustain wealth across generations have strong, shared narratives. Stories about the founding generation. Stories about specific challenges the family overcame. Stories about values expressed through financial decisions. These narratives are not just family lore. They are psychological infrastructure. They create identity coherence, a sense that each family member is part of something larger, something ongoing, something that existed before them and will exist after them. Identity coherence, it turns out, is one of the most powerful financial instruments ever discovered. Because when a young heir understands deeply who they are, where the wealth came from, what it cost, and what it is for, they make fundamentally different decisions than an heir who simply receives a large sum with no context. One heir is psychologically equipped, the other is psychologically at risk. The tragedy of most inherited wealth is not that heirs are lazy or irresponsible, it's that they were never given the context, the psychological and philosophical preparation to understand what they were receiving. The failure is a failure of transmission, not of character. And this is the point that should hit you hardest, whether you have $50 million or 50,000. The principles operating at the ultra-high net worth level are not exclusive to that level. The dynasty mindset, the long time horizon, the integration of financial and human capital, the stewardship framing, the deliberate transmission of financial culture to the next generation. These are available to any family at any level of wealth. The difference is that the ultra-wealthy have been forced, by the scale of what they're protecting, to formalize, systematize, and professionalize these practices. The rest of us have been left to stumble across them accidentally, if at all. You were told that wealth is about earning more, about working harder, about picking the right stocks, and there's some truth in all of that. But what nobody tells you is that the families who actually sustain generational wealth are not primarily focused on earning or picking or even investing. They are focused on architecture, on culture, on time, on the invisible systems that determine what happens to money once it arrives and whether it stays. The $50 million playbook is not a secret because it's hidden. It's a secret because it's written in a language that most financial education never teaches. It's written in the language of governance and philosophy and multi-generational psychology, not just in the language of assets and returns. Every family has the potential to shift from a consumption mindset to a stewardship mindset. Every family can begin extending its time horizon. Every family can start having the uncomfortable, necessary conversations about values and legacy and what wealth is actually for. The families who break the shirt sleeves to shirt sleeves curse don't do it because they're extraordinary. They do it because they decided to be deliberate about time, deliberate about structure, deliberate about culture, deliberate about the story they tell their children about what money means. That decision, that single, foundational decision to treat wealth as a system rather than a number, is where the divergence begins. It's where it has always begun, and now you know it exists. The question is what you do with that knowledge, and the answer to that question is entirely yours. If this changed how you think about wealth, even slightly, that's the beginning of something. Subscribe to FinTrove for more frameworks like this one. The next video goes even deeper. You won't want to miss it.